Hey, I have to delete previous recordings. Okay, let me see. Good evening and welcome once again. So this session is organized by DeBright and AI for the preparations for the financial management exams, right? So tonight we'll be looking at capital budgeting and investment appraisal, right? Um, so we started with the part one already of it, and this is the other part. It's likely that this one will be coming to the exams because it is very detailed, and that is the key when you talk of capital budgeting. In fact, this is capital budgeting. This is actually capital budgeting. So let's quickly go to the format of how it will be like. The capital budgeting will be like. All right. So the capital budgeting. This is the format. We have to look at get the net cash flows, right? We have to get the net cash flows so that we would discount this net cash flows into their present value to be able to analyze it in terms of the net present value and other techniques, right? So we can have this format to determination of what net cash flows. So we start with the operating what cash flows. Want to look at operating cash flows, and we know that it starts from what year zero. Year zero means the present year, that is today. So year zero, year one, year two, year two, year three, year four, or year up to year five, right? Or more than you can get. You can get more than 5 years, but usually it's maximum of 5 years. Usually maximum of 5 years, right? So this is format. So this is the format. Let me indicate that it's the format. So we can have our operating cash flows. Let me bring it to the top. So start with our revenue or our sales, right? It's like the format of the income statement that we know. So it follows that same idea, right? So we start with the sales, which is here operating what the operating sales or revenue, right? Operating sales or revenue, right? So we can term the last year is known as the terminal year. The last year is known as the what? Terminal year. And these years are known as what? The interim years. The interim years, right? Or the interim periods. And the last year is known as the terminal year. Okay. So operating sales. So we can have operating sales for year one, for year two, year three, year four, year five. right? So getting your operating sales or operating revenue, then you move on to the operating costs. What are the operating what? Operating costs. So this looks like the cost of sales under the trading profit and loss account, right? Or the income statement. Trading profit or loss account, or the what? The income statement. So here you can have your variable cost, right? Your variable cost. So variable cost, cost, variable cost. And you can also have your incremental fixed cost. Listen to the incremental. Incremental or fixed cost. If the fixed cost is fixed, then it is not relevant in our decision. But if the fixed cost is incremental, it varies, it changes, then it becomes relevant in our decision. Incremental fixed cost would come. Incremental fixed cost. If it is just a normal fixed cost without any inflation, then it wouldn't be relevant in our decision, right? It won't be relevant in our decision. Then we can have your selling. The selling and admin expenses. Selling and admin expenses. Selling and admin expenses. Someone is speaking. Is that Belinda? Selling and admin expenses. Okay. Then you can have a one-time insurance, right? Maybe they paid an insurance in a particular year. One-time insurance. So let's say in the year 2, right? Then we have capital allowance. We have capital allowance. So capital allowance, we know that is the tax man's what allowable depreciation, right? So the tax expert or the GRA doesn't allow depreciation. So depreciation is not an allowable expense, right? We disallow it. That is GRA because it looks like it's not a cash flow, right? It's not an actual cash flow. So GRA replaces it with what? With the capital allowance. Because if you allow everyone to choose their depreciation, this one will say me, I'm depreciating my assets at this rate. Another company will say me, I'm depreciating my asset at that rate. So you see, there's no inconsistency, right? There is inconsistency in the depreciation rate. So that's why the taxman will bring his own depreciation, or GRA will bring their depreciation, which is an allowable one, which is known as the capital allowance. If you see capital allowance, it is a legal depreciation. Depreciation that is legally what? Accepted, right? Depreciation that is legally what? Accepted. Some people decide not to bring this capital allowance on the face of the cash flow. So some people decide not to bring the capital allowance, but then they introduce the tax. That means you are not going to see savings, right, to represent it. So you can decide to go with that or we'll go with this one. All right. So going with this one, but professionally or in practice, usually they go with they don't present the capital allowance on the face of the net cash flows, right? They don't present it here, but they do the workings and then bring the tax savings. But you can, for exam purposes, you can decide to bring it here, right? You can decide to bring it here. So let's maintain it here. If you would like to use the tax savings to or the tax shield, that one is also there. I don't know whether I should take you through both steps, whether you would like the tax savings ones or this one. So let's work with this and see. So capital allowance. Capital allowance. All right. So after deducting our capital allowance, then we can actually our operating profit. Our operating what? Profit. Our operating profit. So note that it is our operating profit that we charge our tax. It is our operating profit that we what? We charge our tax. Our operating profit that we charge our tax. So if you have to deduct the allowable depreciation, right, the capital allowance to get operating profit. So now we can compute our tax. We can less our tax. So the tax, let's say 25%. Let's say if you're having 25%, you compute on that, the 25% that. You compute the 25% on that. Right? You compute the 25% on that. Then the capital allowance, we deducted it just to help us get the operating profit. So we are going to add it back. So indirectly, it is cancelling itself. So capital allowance, we are adding back the capital allowance. It helped us to get the operating profit. To add back the capital allowance. So the capital allowance, we deducted it. Now we are adding it back. It just helped us to arrive at the operating profit. Then we can have our operating what? Our operating cash flow. Our operating cash flow. Our operating what? Cash flow. Our operating cash flow. All right. So now we actually want our net cash flow, not the operating cash flow, right? So how then do we get the operating cash flow? How then do we get the operating cash flows? So we get the operating cash flows by now going to the investment. Right, so investment cash flows. We have to deduct all the investment cash flows. All the investment cash flows. So the investment cash flow is the initial outlay. Right? That will be our initial outlay. Right? So that is at year 0. That is at year what? 0. That is today. And then if there is any what else? If there is any scrap value, right? Any scrap value. So scrap value, and I believe you know that the scrap value is at the terminal year. It's at the terminal year, right? So the scrap value is usually at the end of the period. So you can that scrap value is when you sell the asset, the proceeds that you are getting from the sale of the assets. So I believe that will be an input. That will be an what? An inflow. Because that is the proceeds that you get when you sell an asset. Right? That is the proceeds you get when you sell an asset. And we can have working capital too. Working capital is what? It's outflow. That is your investment, right? Sometimes you can just get one working capital in a particular period. Let's say year one, working capital, like this. That's all. So since it is an outflow, that same amount will be recouped at the end of the period. You are investing in working capital. You know that in the future you are going to get back your money, right? You are going to get back your money. So that is the working capital. You invest in inventories, your receivables, the payables, and the rest, right? They are investing today, knowing that at the end of this recouped it positive. A question, more than one working capital. So they'll give you working capital like this. Let me use an example to explain it. Figures. Let me use figures. So working capital 1,200, working capital 1,000, working capital 800, working capital 1,100, working capital 900. So they'll give you more than one working capital in the question. So you know that it means that year one, no, it should start from year one. So let me claim the one starting from year zero. So let's say working capital, right? In year one is 1,000. Then in year two, they said the working capital that we need is 800. It means that the working capital has fallen. Initially, we needed what 1,000, right? Initially, we needed what 1,000. So if we need the 1,000, okay, the working capital should actually even start from the. Let's start from the beginning. That is today, year zero. So initially it was 1,200, and now it's 1,000. You know that the working capital is an outflow, right? So if they give us that initially it was 1,200 and now it is 1,000, it has fallen by how much? By how much?
200.
By 200. So if it falls like then it is an inflow. It becomes an inflow, and that is the inflow that you be sending to this workings. That is the inflow that you bring here. Now we're having 200. Now when you move to year two initially was 1,000. The working capital was 1,000. Now it decreased to 800. So what would be the difference?
200.
What would be the difference? The 200 is an inflow. It will be an inflow, right? Then in year three, 1, 2, 3. Now the working capital increased to 1,100. So it means that in after that year two, you were having 800. Now you needed 1,100. So this becomes an additional outflow that you have to incur. So what would that be?
300.
300. So this becomes an outflow, right? Then here, now it is 1100. It decreased to 900. What would be the working capital?
Inflow.
Is it an inflow or an outflow?
Inflow.
It's an inflow because you needed initially you needed 1,100. Now they say you need 900. Means that you are recouping it. You are getting your 200 back. Then at the end of the period, you would. Who can tell me what would be the amount at the end of the period?
400.
What would be the amount at the end of the period?
400.
300. Is it 400 or 300?
300.
300.
Why 300? You can explain that.
Because you are going to add the 200 and then subtract 300.
We subtract the outflow.
We are going to add a 300. Now we are having 200. You subtract the outflow from the what?
Inflow.
So which one are we subtracting from which?
So you are going to subtract the 300 from the addition of the 200, 200, 200.
The 200, make it 600.
Okay, so 600 minus
300.
300. Is that what you are saying?
Yes, please.
Yes, please.
Ayo, okay. So then we get our final figure here. So after getting it, so usually this is how you should be. You should be expecting something like this, or the simple one that they will just give you the working capital one, working capital at year 4, at year 3. So I'm just informing you that you should something like this can also come. So if it comes, this is how you analyze it, right?
Okay, sir.
So a question.
Okay.
All right. So with the working capital, if they give it to you in year 2 or 3, are you going to add or deduct from that specific year or at the end of the year?
So if they give you, let's say, year 4 working capital, at the end of the year, you are going to recoup that whole amount. So let's say here is 400. At the end of the year, you recoup your 400 back.
Okay, so mean that in the year 4 you will not deduct from it, or you deduct.
You not deduct what? Deduct from which
deduct
one?
the 400, yeah.
From here.
Yes.
Do you mean from here? Yeah,
yes.
Of course you're going to deduct.
All right. Yeah. So and also
at the end of the year, you're going to recoup all the 400 that you invested.
Okay. So if they give the working capital to you without any identification, meaning it's going to be an outflow, right?
Yes, it's going to be an outflow. Working capital is an outflow, but that is your investment. It's part of your investment. So at the start, it will be an outflow. But if it decreases like the illustration that I did, that's where it will become an inflow at some point. And then if it increases, then it becomes an outflow in that order. So that one, this one, you do the working sum when that being the 200, is it 300 here on the face of the net cash flow.
All right.
Okay?
And also, yes, and also with the investment cash or the initial cash flow, are you going to deduct it from the last one? Oh.
Are you going to deduct from
the last year or from the year?
The investment investment is at the beginning. When you are starting a business, you start at the year zero today. So you invest today. So it will be at year zero, which is today. The scrap value is at the end. When you sell the assets, that is where you get an inflow that is at the terminal year. I don't know if I get your question.
Oh, yeah, so meaning the investment cash you subtract from the initial year amounts, right? Initial year
the investment
cash flow.
Which is the zero? Yeah, zero.
All right, sure.
Yeah, so it will come here as the same amount. Then if you deduct, there is no figure at the top, so it will still come here as the same amount, the outflow.
Hey.
Can we continue?
Have you put my bag
Yes,
inside?
please.
Hey, God bless you, bro.
Okay, so let's proceed. Bright, I'm sure I've answered you.
Yes, please. Thank you.
Okay. Okay, so let's proceed. All right, so what else? Then we can finally get our net cash flows, right? Our net cash. So here, I'm just assuming the working capital is just at year 3. Is it year 3? Yeah, year 3. Then we get our net cash flows. So this net cash flows will be the amount that we compute our discount on. All right, this will be the amount that we compute our discount on. So in fact, when you are going there, you need to know your format, right? So if you bring the capital allowance, it means you are not going to see any tax shield or the tax savings once again. But if you decide not to bring the capital allowance, then it means you are going to see the tax savings and the tax shield. All right. So I don't know if I should do the workings for the tax savings, because if you bring the capital allowance, there's no need to bring that. So it means that we are all going with the capital allowance, bringing it on the face of the cash flow, the net cash flow. So it is this on this amount that we the discounts.
Yeah. Hello.
So yeah, hello.
Yeah. So with the tax savings and the capital allowance. So in the case of the give you both of them, are you going to go with one, or always they specify one for you?
Come again.
With the tax savings and the capital allowance, are you the one you decide on the one you are going with?
The one that you are going with, in terms of presenting it here.
Yes.
In terms of presenting it here.
Yes.
Yes. You will decide whether you are going with the tax savings or the capital allowance.
All right, sure.
So in class, which one did your TA use?
Yeah.
In class, which one did you use? Tax savings.
Capital allowance. Capital allowance.
He used capital allowance or the tax savings? He used both.
Capital, yeah.
Okay. All right. So you can use it, right? You can use it. I wanted to show you the tax savings, but in fact, if you use the capital allowance, it's okay. But want to move faster. So this is where you compute your discounts on. So discounted cash flows. So the initial would be an outflow, and then you get blah blah blah.
I don't know what I would do. Oh, you get it.
All right. So that is it. So on that note, let's try to start solving the problem. So I believe you are going to use this discount factor, and you are familiar with it.
Hello, sir.
Right? Yeah, hello.
Yeah, please can you scroll down to write the format of the class? Hello.
Because
It
if
will be
you go
recorded.
to one year before, I will do the best.
Yeah, hello.
Yeah, please.
You don't know when you go back.
Some people are talking at the background. Who are those listening? Hello, can you hear me?
Yes, please.
So someone was on the floor. The one who
Yeah,
said he wants to take shots. Are you fine now?
yeah, so scroll up.
The woman come. The woman come. You are the for the but the woman come be the ___me.
At the mall,
Yeah.
your microphone. With that.
Yeah, thank you.
They see they open the kind back. You know they see. You know they see they open the kind back. Jack for there, right? Hey, I know.
All right, so can we continue?
Yes, please. We can continue.
Okay. So now let's go back to the question and start looking at the question.
Where they go? They only do a come. Yeah, we will be able to that be true.
Okay, so someone should take us through the question. Read the question for us. Those speaking at the background, we can hear you. There's a guy speaking.
Evaluating an investment.
I just maybe so they do.
Farmers Alliance evaluating an investment proposal to manufacture product DD3, which requires an investment.
Hey, is someone reading?
It's gonna be how much?
Farmers Alliance evaluating an investment proposal to manufacture product DD3, which requires an investment in new machinery. It has performed well in test marketing trials conducted recently by the company's R&D department, which cost the company 5,000 Ghana cedis.
500,000.
500,000 Ghana cedis. The management accountant accounted for R&D costs as part of the initial investment in machines. The management accountant has prepared the following information relating to the investment proposal. Initial investment in machinery, 9 million Ghana cedis. Selling price, 40 Ghana cedis per unit. Expected selling price inflation, 3% per year. Variable operating cost, 16 cedis per unit. Fixed operating cost, 340,000 per unit. Expected operating cost inflation, 4% per year. The R&D department has prepared the following demand forecast as a result of the test marketing trial. The forecast expected technological change in its effect on the anticipated life cycle of DD3. So year one, the demand is 120,000. Year two, the demand is 140,000. Year three, 240,000. Year four, 90,000. It is expected that all units of product DD3 produced will be sold in line with the company's policy of keeping no inventory of finished goods. The expected machinery terminal value or machinery scrap value at the end of the 4 years when production of product DD3 is planned to end is 2 million Ghana cedis. The machine attracts 30% capital allowance on reducing balance method. Farmers Alliance used a nominal discount rate of 15% per year and the target return on capital employed of 25% per year. Corporate tax is 25% and paid in the same year as related profit. The target payback period is 3 years for the company. Required: A. Identify and explain briefly the stages in capital investment decision-making process. 3 marks. B. Evaluate the proposal using the following techniques. I. Net present value. II. Internal rate of return. III. Discounted payback period. IV. Accounting rate of return. C. Discuss your findings in each section of B above and advise whether the investment is financially viable.
All right. So thank you very much. So this is a proper capital investment or capital appraisal question, and it's a session B question, right? So I can see that you have a lot of. You can see that we have a lot of information, and it is then that to go according to steps. All right, so you have to do some workings before you present it on the format, right? Determining the net cash flows. So you have to do your workings neatly so that you can just transfer the figures and send it to. So already we know our format to be the operating revenue, right? Then we deduct all the operating costs that are associated, right? Then we can get our operating profit. Then it is out of the operating profit that we compute our tax, and then other costs will be deducted to get our net cash flows. So here we can see from here that Farmers Alliance blah 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 requires an investment in new machinery. It has performed well in the test marketing trials conducted recently by company's R&D department, which cost the company how much? Which cost the company 500,000 Ghana cedis. Right? So that is what. Who can tell me what is that?
That's the initial outflow.
So that is initial outflow.
Outflow.
Okay. And they said that the management accountant accounted for the R&D cost as part of the initial investment in machinery. The management accountant has prepared the following information relating to the investment proposals, right? So this is in relation to the investment proposals. All right, and they said the initial investment in machinery is how much? 9 million. Wait, did we say that? Did someone say that is the initial investment? Someone said this is the initial investment. He said it has performed well in test marketing trials conducted recently by the company department, which cost the company 500,000. So this is like the research and development. I believe under which topic in FR? Which topic in FR do we? Oh, under which topic? That is when all items. PP.
Intangible cost of an asset.
Intangible assets. Is it?
For assets.
Oh, okay, very good. So you see, this is the cost that is associated with what before getting the what before you use the assets, the cost that is attributable to the what to the assets. So you see that this cost has already been incurred. It has already been incurred, 500,000 to research. Let's say you are going to buy an asset. When we were going to buy the asset, we research. Let me go check. Say, asset it's saying you so then right? So you are going to do research. So you go and research about the asset. So you see that even before you incur the initial investment, you had already incurred what? A cost of how much? 500,000. So who can tell me which type of cost is this? Which type of cost? What type of cost is
Sound cost.
Sunk cost. This is a sunk cost. Why? Because it is a past cost.
I'm not
You had already incurred that cost already. So you see, it is not relevant in our decisions. When you start to get to level 400 and you do management accounts and you would appreciate the a consent.
Yeah, so I think according to the slides, so is it
hello, did you say a consent?
Yes.
We have what?
Yeah, I think in the slides, you see we have initial expenditure where it includes research and development. Though we know about the sunk cost, all right. So here I don't know. So we'll be contemplating whether it's going to be research and development as part of the initial expenditure or to treat it as a sunk cost.
So listen to the statement. It has performed in testing marketing trials conducted recently by the company, which caused the company. So it's like before a test, an initial test that has already made. Before you actually incur the initial cost, what could trials be? What I say, you have gone to do some trials, and those trials they are costs that are past. When you get to relevant costing, you know that relevant costing is we want the cost that will help us in making decisions, and we want future costs, right? We want future costs. We don't want past costs. So under relevant costing, we have that's why we said under relevant costing, we are focused. Our focus is on the future cost, right? Because it's the future cost that we can make a decision on. That will help us make a decision. Something that has already passed. Can you make a decision on something that is already passed? I didn't see that it is already what passed. So you can't make a decision on that. We then you see that, right? But it is the future that we can make plans on. It is on the future that we can plan on. So if you are incurring a cost which is for the trials before even we incur the initial cost, that cost is irrelevant. It's irrelevant in our decision making, and that is a sunk cost. So in fact, even the initial investment include the sunk cost because it is under IFRS. They said it is part of the what cost. It's under what is it intangible assets, as you said? Yeah, we said that it is part of the what cost. All the costs attributable to making the assets in a workable condition, right? Something like that. So it means that even the 9 million here is even includes the sunk cost because what the financial standard is saying, right? The accounting standard is saying. So it means they have embedded the 500,000 here, which is part of the cost. So the 500 is part of the 9 million. Because the initial cost, the cost in testing everything before you arrived at the 9 million cedis. Are you fine now?
Yes, sir. Thank you.
Welcome. So now that is the initial course, right? So before you start, you need to understand this before even you come down. Then we come to under financial management and management accounting. Just a word can change everything. So it is very, you have to be very careful. When you get a question like this, don't rush and start. Hey, make sure you understand everything. Because this same question is, hey, who is that? All right, let's continue. So you can see that all the informations are relevant. This same question is in your book, right? In Paul's book, the financial management book that is sold to you. But they changed something small, and that thing, because of that thing that they changed, it has changed the solution. But this is the original question, right? So after solving this with you, I believe you can go and do that. It is just something small that they've changed, just a little thing. I'll show you how to do it. All right, so now we have the selling price. We have the selling price. It said current term selling price is 40 cedis per unit. That is the current term. Current price terms 40 cedis. Then expected selling price inflation 3% per year. It has been what inflated. If you inflate it, it means there has been what inflation. So we need the inflated what amount, because current price means the price that is an old price, and we can't use an old price in our decision. We want the current, what I said, we want the actual inflated price. So that's what they're giving you the expected selling price in the future. It is the future thing, so expected selling price. Then we have the variable operating cost, current terms. We have the fixed cost, current terms, 340,000 per year. Then we have the expected operating cost inflation, 4% what? 4%. So we would have, assuming it's just 340,000 for the fixed cost. Fixed cost is fixed, so it is not relevant in our decision. Whether you do this or that, the cost is what? Fixed. Whether you go to the left, you come to the right, the cost is what? Fixed. But it is the incremental fixed cost that we add in our the determination of the net cash flow. So here, the expected operating cost inflation. I believe fixed cost is under the operating cost, so it will also be affected with the what 4%. Assuming we didn't see any expected, they said we didn't see any expected here, and they said expected variable operating cost would not have brought the fixed operating cost, because it is 340, and because of that, it is not relevant in our decision. So here it is what inflating. So we are going to use it. R&D department has prepared the following demand forecast as a result of 8 test marketing trials. The forecast reflects the expected technological change and its effects on the anticipated life cycles of product DD3. Year 1, they've given you the demands, right? So these are the sales in units. The 120,000, year 2, year 3, year 4, right? Then it is expected that all units produced will be sold in line with the company's policy of keeping no inventory of finished goods. The expected machinery terminal value or the machine scrap value at the end of the 4 years when producing product DD3 is planned to be what? 2 million. So what is this? What is the 2 million?
Is it scrap value?
That's the scrap value. And look at it, it's the terminal value. I told you the last year is what? The terminal value, right? Under the format, I said the terminal value is, terminal year is what? That is the last year. So year 5, I wrote it at the top. And the other years are the interim what? Interim periods or the interim years. So here, that's what the scrap value we usually bring it at the end, right? So now, they said the machine attracts 30% capital allowance on a reducing balance method, not a straight line method, on a reducing balance. Farmers allowance uses nominal money discount rate of 15% per annum and a target return of capital employed 25% per year. Corporate tax 25% paid in the same year. Some of the questions will say corporate tax paid in 1 year in arrears. 1 year in what? Arrears. This question is saying that and paid in the same year. So we bring it under it. Right? But the one that will say that 1 year in arrears, I believe you understand 1 year in arrears, means that it will not be the same year. It will not be what? The same year. Right? So the tax rate for year 1 will be paid in what? Year 2. Assuming the question said that in arrears, tax are paid in arrears, 1 year in arrears. So the tax rate for year 1 will be paid in year 2. Tax rate for year 2 will be paid in year 3 in that order, right? So that is it. You need to be careful of the notes, what you have under the what tax the rest. So identify and briefly explain the key stages in the capital investment making process. So what are the stages under the capital investment decision process? Yes.
You budget, you identify, then you evaluate, you select.
Identify.
So are you going to list all the 6 steps, or is it 6 or?
How many steps do you have?
6.
All right. So what's the name of the business? Farmers Alliance, right?
Yeah.
So what are the stages? List them. 1 is what?
Budget.
Wait, so there's a concern here. You see, in the slide, they made determine the budget first. But in the textbook, it was the identify investment opportunities. That was the first step.
You know, give the one that the lecturer wants to. What is the lecturer saying? He will be the one to mark the exam. So, did he prepare the slides? I'm sure he prepared the slides, right?
Yes.
And it's the same person that made the book. So, which one should we choose?
The
book.
And the book, no,
the
okay.
Book, the book.
The one that taught us is different from the one that is the book for. So it was Makosa that taught us.
Yes. In the slides. With respect to the slides.
Yeah, and he prepared the slides. And he also said the questions also.
You were told he said the question.
Yes.
But
actually, I don't know.
Anyway, I'm thinking let's go with Prof. So because Prof is the head for the financial management, right?
Yeah.
So so you just give him what he wants. I heard that something I've been saying that people have been teaching people wrong things and stuff. So that's why I want us to go with what exactly he is saying. So I'm not coming to do a different thing here. I'm trying to do exactly what he says. So that's what I'm asking from you. What are the steps? Because what are the steps or the stages?
Identify investment opportunities.
Are we going with the book or with the slides?
The book.
With the book.
So the first one is identify
Investment proposals, opportunities.
Identify investment opportunities proposals. In fact, let's not delay on this. So you know it, right? Yeah, so let's quickly go.
No, we don't know.
We know very
Identify investment Identify investment. Not everyone will buy the book. Identify investment proposals or opportunities.
Yes.
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 Secondly,
Determine the budget.
determine the budget.
Budget.
Uh-huh.
Screening
Screening
investment
proposals.
Screening investment
proposals.
proposals. What else?
Analyze and evaluating investment proposals.
Come again.
Analyzing and
Analyzing
evaluating
and evaluating
investment proposals.
investment proposals. What else?
Approving investment proposals.
Approving
Investment proposals.
proposals. What else?
Implementing, monitoring,
Implementing,
monitoring,
monitoring,
and reviewing investments.
and review
Investment. Yep, that's all.
All right, thank you very much. Okay, so the B is our focus, right? So we would have to prepare, lead the format, so determination of net cash flows. All right, so how many years were we given?
Four.
So that's, is it 4 or 3?
Four.
Yeah, 4, right? Yes. But you see, this question, we have already gone through it, and we did not see anything like in arrears. The corporate tax was paid in arrears. But usually, I advise that you make it 5. When you get, so if they ask for 3, you make it 4. If they ask for 4, you make it 5. If they ask for 5, you make it 6. Because when it's in arrears, it means that other one will come to the next year, right? Yeah. I believe you get what I'm saying.
Yes, please.
Yes. So it's, with this question, there is nothing like in arrears. So that one, we know that, we already know that the year 4. But usually it's prudent to add an additional year so that it will take care of any adjustments, right? So that is it. So year 0, year 1, year 2, year 3, year 4, year 5. Maybe we know, but let me bring it because. And then we have the operating cash flow. We want to know our operating cash flows. All right. So we can lay the format, and but before that, let's go and do our workings and come back. Let's go and do our workings and come back. So we'll do the workings for. So this is our workings neatly. So because the sales is also having an inflation factor, or it will be inflated, then it means we have to sales is over selling price, current price then is what 40 cedis. Expected selling price with inflation is 3%. So we need to what inflate it by the amount. So it will no more be 40 cedis, but then with a new amount, right? Then we'll get a selling price and then we'll multiply it by the number of units. How do we get our sales? Our sales is what? How do we get our sales? So that is what the price times what the quantity. So when you after inflating, you need to multiply by what the quantity here. So it's the same analogy. So here we can have the various what demand units. So let me make it this way. 0, 1, 2, 3, 4. So selling price. Selling price. So what is the selling price? Is for 40 cedis. Hey, introduce my. So it's actually Ghana cedis, right? So selling price is 40. And then the inflation. What is the inflation factor? What is the inflation factor?
The question is not yet.
3%.
Okay, so the inflation factor.
3%.
Selling price
3%.
is 3%. Okay, so
3%.
with the 3%, we are going to inflate it. So we have 1 point. I believe you are familiar with this, right? Something like this. When you are inflating it, it is 1 plus 3%, right?
Yes.
Okay. So that is what I'm having there. So 1.03 for how many years? This year 1, right? Year 1. Then 1.03 year 2, 1.03 year 3, 1.03 year 4. Someone can also do this, the first one, 40 times 1 point this. Whatever figure he gets, then we'll bring it here and multiply it by the 1.03 without bringing the exponents. I don't know if I'm making sense. Am I making sense?
Hello.
Someone?
Yes.
Hello.
Please, how did you get
Okay.
the
How did I get what?
The 1.03.
It is in the question. In the question, is it the expected selling price inflation 3% per year? So look at the 3%. The selling price is what 40 per unit, 40 cedis per unit. So 3% is what the inflation amount. So you are going to inflate the 40 cedis with the what 3%, right? So 3% is the same as 0.03. Remember, under time value of money, we say 1 plus R, future value. Do you remember this?
Yes.
Right. So if you want the future value, present value 1 plus. So that is it. So I've just added everything. 1 plus 0.03. 1 plus 0.03 or 1 plus 3% should give you 1.03. So that is it. I believe you are fine. All right. So what I'm saying that if someone can do this 40 times 1.03, whatever figure that the person gets, the person will bring it here and multiply it times 1.03. So what are we getting here? What are we getting? 40 times
1.03.
What do you have? That is what?
What's 1 point?
41 point.
2.2.
0.2 years. So someone can bring the 41.2 and multiply it times 1.03 without bringing these two. Or you can list them 40, 40, 40, and then you increase, just be changing the powers, right, or the exponents. So that is it. So 40 times 1.03 times 1.03 or exponent 2. What do you have?
Exponent 1.
42.436.
42.436.
Yes.
The 44. Then what do you have here?
43.70.
43.70. Then the last one is what?
Yeah, it will be 43.71.
Is it 71?
Yeah, it's 70908. So 2 decimal.
It's 71. Okay. Then the last one.
45.02.
45.02. Okay. So this is our selling price. Inflated. Right? So this is our actual selling price now. Now this selling price would have to be multiplied. This is our current. So we can multiply it times the what? Times the demand. Demand, right? The demand in units. The demand in units. The demand in units. How much is for the first year? The demand in units is what? 120,000 for the first year. 140, 240, 90. So is it 120 for the first one?
Yes, please.
Yes, please.
Second one is what?
140.
140,000.
And the third one? 240,000. Then the last one,
90,000.
hey, who be that?
That's funny.
Okay, so then the last one it was 90,000. So then what is our revenue? What is our revenue?
4,944,000.
4,944,000. 944,000. Hey, look at that. Then the second one is what?
5,944,000. 941,000. 600. 600.
600. The third one?
10 million.
Someone should be punching the last one. 10 million.
490,400.
490,400. The last one?
4 million.
4 million.
51,000.
4,051,000.
No, 50,000.
800.
Hey.
What kind of figure is that?
4,050,000.
And 51,800. 4051.
4,051,800.
800.
So this is our revenue, right? So we can go and insert this revenue, right? Hey, SaaS space means sir. I thought I left my space. Oh. Yeah.
No me afraid an email.
So is there a way you can just do all the workings afterwards, then you start with the determination?
Straight for the workers. I'd left a lot of space. How do I even catch this thing? Copy and uh,
I need to suggest you claim the work and since you copy this.
I
sorry.
also suggest you write the answers for selling, like the revenue, and then you just clean the workings.
Oh, okay. Good. So I believe you all have it. You can take shot of it so that because I want to clean it. So let me just write the revenue figures. As hold on. I'm sorry for. Can I proceed now?
Yes,
Yes, please. Yes.
So revenue, right? Operating revenue, sharp. As year one near there. Hey, in millions, should we bring zeros at the top?
yes. If you please, sir.
No.
Nah.
No,
We
no.
shouldn't bring it.
No.
We shouldn't bring
No.
We shouldn't bring. Oh, okay.
Right or
So year one, 4,9. Is it 499?
4,944,000.
4,944,00. The year two.
5,941,200.
5,941,20. That year 200.
600.
6.
Yeah.
Year three.
1049,0400.
1049. 1049.
490. Yeah.
Then year four.
4051,800.
4051,800. Right. So that is our revenue. Then I'm continuing the workings. So this workings one, workings two will be on this page. Workings two. So workings two is about what? The next thing is our variable cost, right? From the format, the next thing is our what? Is our variable cost, right?
Yes.
Yes. So variable cost. So for the variable cost, oh, How do we get the variable cost? The variable cost is the variable cost per unit. Variable cost what per unit. So they give us the variable cost per unit. What is the variable cost? Is that the variable operating cost is what? 16 cedis per unit, right?
Yes.
Can you see that? 16 cedis per unit. Alright, so 16 cedis per unit. Let me. Yeah, 1, 2, 3, 4, 5. So variable cost per unit, 16 cedis, 16 cedis, 16 cedis, 16 cedis. All right. Then what is the inflation factor?
4%.
Inflation factor. The inflation factor, 4%, right? So that's 4%. So 1.04 year one, 1.04 year two, 1.04 year three, 1.04 year four, right? So then this is still a variable cost per unit. So what would be the variable cost per unit?
16.64.
16.64. Second one,
17.31.
third one,
18.0. 18.7.
and then the last one,
18.7.
18 points. Is someone speaking?
18.72.
Please, how do you get it?
My point to say.
Is that how did you get what? Demand in units, right? So you have the 120,000, you have the 140,000, 240,000, and 90. So you see, when you're done with the working, and now I go insert it on the format. So now, what are we getting?
1,996,800.
1,906,800.
1,800. 800. 996,800.
Hello, sir.
What is? Hey, are we here? Yeah.
We can't hear. I can't hear you.
Yeah, what are we getting for this?
2
I
million.
can hear you. Can you hear me now?
Yes.
Yes, yes. We can hear you.
2 million.
423,400.
2 million.
423,000.
2,423,000.
100, yes.
Okay. Another one.
4 million.
4 million.
320,000.
300,000. Then the last one is what?
1
1
million.
million.
684,800.
684,800.
800.
All right. Then we are done with the variable cost. So let's go ahead. Please keep these figures. I'm going to record them at the variable cost side. Can I move? Has anyone captured the figures? Can I move to the main work?
Yes, sir. You can go.
Okay, so give me. All right. So our operating cost. So our operating cost. The variable cost. What is the variable cost?
1 million. 996,000. 996,800.
800. Okay, second one.
2 million.
2 million.
423,000.
423,000.
400.
The third one.
4 million.
4 million.
20,000.
4 million what?
320,000.
350,000. And the last one.
1 million.
1 million.
684,000.
684,000.
800.
600. All right. So that is the variable cost. We can go and do which one? Fixed cost. So the next one is what? Fixed operating cost. Who is that? Hey. I don't know accounting now. All right. So the next one is what? Fixed operating cost. Fixed what? Operating cost. And it's 4%. But we would have ignored this if it is just like that. But because the expected operating cost also affected, we would also do the working for the first cost. We also do the working for the first cost because of the expected operating cost. So all the costs, operating costs, they didn't say just the variable, but they said all the operating. So the first cost would also be affected by the inflation. So that is 4%. So working for the first cost as well. All right. So what is the first cost actually? So the first cost be 3. Let's see, 1, 2, 3, 4. So 340,000 throughout. Right. Then we have the inflation factor. Inflation factor is 4%, right?
Yes. Deliberately failed to think.
Give me the figures.
353,600.
3 what? 053.
1,600.
600. The next one, please. The rest will be punching the rest quickly. Oh, sorry.
367,000.
The second one is what?
367,000.
367,000.
744.
744. What else?
382,000.
382,000. 453. 382,000.
382,000.
453. Point 76.
453.
Point 76.
4.
Point. Full figures.
Okay.
Point what?
Then point 76. So the full figure will be 382,454.
Of course, yeah, give me the full figures.
Yeah, that's it.
And the last one.
397,000.
397,752.
752. 752. All right. So that is the first course. So quickly, let's find the first course.
Damn. Why am I?
So first course. Take short of the first cost. Take short of the figures. So that you give it to me. Give me the figures.
Oh.
The first cost.
I didn't finish.
353,600.
I'm sure someone has taken. Hurry up.
Yeah,
What do you have?
353,600.
353,600.
353,600.
367,744.
367,744. Yeah. What else?
382,000.
382,454.
454.
And the last one.
397,000.
197,752. 252. All right. What else? Is there any workings to be done on the format? What is the next thing on the format?
Capital allowance.
Professor.
Do you have any selling and admin expense?
Admin and then insurance.
Do you have any selling and admin expense?
No.
From the question. Okay, let's check from the question.
No.
We didn't see any selling and admin, right?
Yes.
Okay. So it means that if you go and see selling and admin, you have to rent it or maybe adjust it depending on the question. All right. So there is no selling and admin here. So the next thing is the And then there's no insurance, a one-time insurance. So the one-time insurance can be in year 2, year 3 or 4, right? So there's no, the next thing is capital allowance. So let's go and compute our capital allowance workings. Let's go and compute our capital allowance. Workings, capital allowance. So workings 4. Capital allowance. So with the capital allowance, we have the cost of the what? Investment. What is the cost of the investment? What was the cost of the investment or the initial cost? So the initial investment cost.
9 million.
How much is it? 9 million, right? So 9 million.
9.
That's the initial 9 million. Then we said that there were what? There is a sunk cost. A sunk cost of how much? 500. Sunk costs are irrelevant in our decision. So that is 500. It is not relevant. So we less the sunk cost.
I see.
Or the cost that we use in our research to test the thing. So that is 500. So what would be our cost of investment now?
800,000.
8,500,000.
So that would be 6 million. Did you say 6 million? Is it not 8?
8,500,000.
8 what?
Million.
6 million. All right. So 8,500,000. So this is our cost that we'll be working with. This is our cost that we'll be working with. So year 1, year 2, year 3, year 4. So what will be our cost? Our cost is 8,500, right? And then we compute the capital allowance. So how much? What is the rate for the capital allowance? Capital allowance rate.
25%.
25%.
The capital allowance. The machine attracts 30% capital allowance on reducing balance method, right? On reducing balance method. So that is the capital allowance. So
Yeah, dead.
So 30% on this amount is how much? What is 30% on that amount?
2,550,000.
2,550,000. 2,550,000. Yeah.
So reducing balance method, I believe you know it's on the net book value, right? Or the written down value. So what would be the difference?
5 million.
The initial is on the
50,000.
5 million
950,000.
950,000. So this is the written down value.
950.
It's actually 50. Sometimes I write my 5, but let me write it well. Okay, so now 500, 950,000, right?
Yes.
So this is our written down value when you deduct the what? The depreciation or the capital allowance. So this written, because it is on the reducing balance method, the rate will be computed on what? On the written down value. So this becomes the cost now. Reducing balance method. Assuming it's the initial will be on the cost because you don't have any amount on that. So then compute the capital allowance on the written down value. 30%. What do you have?
1,785,000.
$1,785,000. What will be the written down value?
4,165,000.
4,165,000. So this will be the cost now. Reducing balance method. Reducing balance method. So 30% on that will give us what?
1,249,500.
1,249,500.
249,500.
Then what do you have?
2,915,500.
2,915,000. Is it 500?
Yeah.
Please, I don't understand.
Which part don't you understand?
Where you are calculating now?
Yeah, so the policy of the firm is to calculate capital allowance on reducing balance method. And with the reducing balance method, the rate is computed on the written down value. The written down value is cost minus accumulated depreciation. Do you remember this formula? Then you get a net book value when you are preparing your statement of financial position.
Yeah.
Do you remember this?
Yes, please.
Yes. So if you have something like this, net book value is the same as written down value, or the figure you get after deducting your depreciation. So here, cost minus capital allowance, depreciation, we are going to get net book value. For reducing balance method, we compute the rate of something like this, How do I say? Yes, so that is how it reducing. So take note. Assuming it was a straight line method or the question was silent, you would have assumed that it is on a straight line method. If the question is silent, assume that it's on straight line method. So we would have brought 8,500 throughout if it is a straight line method, right? 8,000 throughout, and then we'll be doing the deductions for each of the words. Yes, right.
Yes, sir.
Are you fine now? Okay.
Yes, please.
So, yeah, hello.
Hello, sir.
Just have a question.
Hey.
Okay.
So, with regards to the sand cost, since it's irrelevant, why did you subtract it from the cost? Because for the definition of sand cost, it has been incurred before this one. So, if it has been incurred before the actual cost of it, which is the 9 million, why then did you subtract it?
All right. So let's go back to the question. Initial investment in machinery, 9 million. By the company's department, which cost the company 500,000. Before you go and buy something. Before you go and buy something, you would do some research, right? You would do some research before you go and buy the thing. So the 9 million here is initial investment in machinery. It means that the research has been embedded based on the financial reporting standard. what is the cost of the project? The cost is any cost that is attributable to the what? To the asset, right? So the cost we are seeing at 9 million, we assume that the 500 is embedded in it, because before they will come out with the cost, all the associated costs would also be what added.
Your chairman.
Right? All the associated costs will be what added to arrive at the initial investment in what amount, because that is what we know. So
Hello.
we assume that the 9 million includes the 500,000.
Hello.
Yeah, hello.
So for what you said so far, anytime you see sound cost in a question, you have to subtract it from the initial investment.
Exactly. Unless under the initial investment, they said the investment excludes, right? They should give you enough information to inform you that it excludes the sound cost. But if it's just like that, investment machinery cost is purchase price plus any cost attributable to the asset. What I say, any cost, which research cost is also relevant, it's also part of the cost, right? So they are just telling us that this 9 million that we are seeing, this 9 million, there's a component of sound cost of 500 in it. So if we actually want the cost per there, we need to deduct the 500 from it.
Hello.
Yeah, hello.
Hello. Yeah, so you said you are assuming that the 500,000 is part of the initial cost. But I think the question is even clear that from where the 500, the management accountant accounted for R&D cost as part of initial investment in machinery.
Hey, I didn't know all that. I won't put that. But assuming it was not, if that statement was even not there, even the statement is even clear. Thank you very much. But assuming it was not there, as far as I'm seeing cost, indirectly, I'm assuming that all the costs, per the definition of your standards, right? We assume that. Thank God that it's even stated clearly. So here it is stated clearly. The management accountant for the R&D cost as part of the initial investment in machinery. So thank you very much. I believe you can proceed.
Is there a question?
Yes.
So with the capital allowance, we've not made a provision for the inflation rate.
We've not made provision for inflation.
Yeah, the expected operating cost inflation.
Sir, please, your line is not clear. We can't hear you well.
Is it a general problem or it's just with you?
General.
It's a general problem. My line is breaking.
Sometimes.
No, your line is not breaking.
Your line is not breaking. Your voice is far away.
Okay. I see. All right, so let me get you. My line Right. Did you ask a question? What was your question?
Yeah, the capital allowance is also part of the operating cost, right?
Mm-hmm. And then we didn't inflate the capital allowance.
Yeah.
So, in your opinion, assuming what rate would you have used to inflate the capital allowance?
So increase the percentage.
Sorry?
The percentage has been given already.
Is that what?
Represent.
I said, what rate would you have used?
Just as we did for the variable and the fixed one, find the rate for each year.
You are thinking that it will also the depreciation has to be inflated. Wow.
Exactly.
Because it's part of the cost.
Yes.
Because it's expected operating cost inflation.
Yes.
And the depreciation, first of all, is it an allowable expenditure? Is it an allowable expenditure to be inflated? So please, who can explain why the capital allowance is not relevant? It's not part of the inflated amount. Because for me, I know capital allowance is not relevant to inflate capital allowance or depreciation. Depreciation is the fall in the value of an asset. So why would you inflate it? It's the cost that would be inflated, but the depreciation, why is it relevant to include it or inflate it? I don't know how to explain it, but anyone who can explain why we
Yeah. So, say,
okay.
so meaning that under the operating cost, when the expected operating cost inflation has been given, you inflate for all but except the capital allowance, right?
Exactly.
Meaning if
So they said operating costs. So all the costs that would be what? Inflate capital allowance, we don't inflate it. Right? We don't inflate capital allowance. So you can do your research and then tell me why we don't inflate capital allowance. Or you can go and ask your lecturer. You are done, but you can just go and pass by and ask him the capital allowance. Why is it that we don't inflate capital allowance? Or maybe the TA Kingsley, right? So that is it. Any other question? I will proceed. All right. So now, what will be the cost for year 4?
$2,915,500.
2,915,500, right? All right. Then what is the capital allowance?
874,650.
874,000.
650.
450.
650.
650. So then what are you getting?
2,040,000.
And 40,000.
850.
2,040,000.
850. 850.
851. Okay.
850 bosso.
Okay. Thank you. All right. So now we are done with the capital allowance. So we need to send the capital allowance, all the figures for the capital allowance to the what? The cash flow, net cash flow. But what will be the last year? Last year we are having 874,650. If there is a scrap value, or we sell an asset, if we sell an asset, we have to deduct the scrap value from the total, right? You have to deduct the what? The scrap value from this amount, the cost. Because the cost of the asset, let's say the cost of the asset is you are having an asset. You're having an asset. And the asset is how much? The cost of the asset as at year 4. As at year 4, now the cost of the asset is 2,000. This is the asset. But then you sold the asset. Someone said, oh, I'll buy this asset. Even though the cost of it is 2,000, do you know something? Let me give you 3,000 shillings. Okay. You see, you let the what? The 3,000. So the 3,000 is the scrap value. You have to deduct the what? the 3,000. If you deduct the 3,000, what are you getting?
Negative.
Negative what? 1,000. Right?
Yeah.
So this negative 1,000, is it a profit to you or is it a cost to you?
Profit.
It's a profit. Hence, there will be a charge on it. So this is balance. It's called balance charge. Right? Balance charge. Because you are making what? A profit. And this profit will be taxed. Right? So this profit will be taxed. Assuming that you are receiving an amount lower than the 2,000, that will be what? Balance allowance. Balance what? Allowance. So with this, if you are having, usually we sell the scrap value. Where did we even bring the scrap value? The scrap value, where did we bring it? Not the format. Where did we bring the scrap value? At the end of the period, that's where you sell the asset. It's an inflow, right? So since it is an inflow, then it means that at the end of the year, if the cost is like this is the cost. Do you have a scrap value in the question?
Yes, 2 million.
Yes.
That is scrap value. The expected machine terminal value end of the year, or machine scrap value at the end of the 4 years when the production is done is what 2 million. It was 2 million. So this 2 million would have to be deducted from this. What do you have?
40,850.
$915,500.
915,500. Right. So this will actually be our capital allowance the last year. This will be our capital allowance. What I say? This will be our capital allowance. So the capital allowance is like the GRA people. This is not a tax class, but they are allowing you to deduct it to reduce what your tax liability. The capital allowance, they are allowing you to do what? To deduct so that you can reduce what? Your tax liability. That is what they are doing. Because if, let's say, 1,000, this is also 1,000, and they are, for one person, we are allowing the person capital allowance. Capital allowance, we are allowing you, this person, A, let's say A and B. We are allowing A capital allowance of, let's say, 25%. How much 25%? Could be how much? We were 250. 25%, 250. This person, we are not allowing capital allowance. So what will be the balance? 1,000. This person's balance will be what? Is it 850 or 750?
750.
750. Right. So now there's a tax rate of say 30%. Who will pay more tax? Who will pay more tax? Which of the two will pay more tax?
B.
Who will pay more tax? So you see that the one that is having the capital allowance he's benefiting. So the capital allowance is a good thing where you are allowed to deduct some of your expenses such that you get an amount that will be lower. So that when we compute the tax on it, you have a lower tax liability, right? You have a lower tax to be paid, right? Lower tax liability. So this amount, after deducting the scrap value, that scrap value you have already gotten what? You You have already deducted the 2 million. So the remaining will be your what? Your capital allowance. And that will be sent to what? Your capital allowance workers.
Hello,
Yeah.
sir. And please, I want
Yes,
to ask why we didn't use the 2,040,850, but instead we are using the 2,915,500.
All right. So the 2,915,000 is the cost of the assets. When I gave the example here, I said 2,000. The cost of the asset is 2,000. Someone said, well, I'll give you 8,000. And we said that was a balance what? A balance charge. Why? Because the 1,000 is like a profit to you because someone has given you 3,000. The tax GRA will want to charge the percentage of the 1,000 that you are getting as profit. GRA want to tax you on that profit, right? Because that one will not grant capital allowance, will tax you on it, right?
Hello.
So now this 2,915,500 is also the cost. So if there's a cost and then there's a value of 2 million, deduct it the same way. We are not going to deduct this one. This is the written down value. This is written down value 2,040,850. Yes, someone was mentioning.
Yes, sir, please, I'm not understanding.
You understand?
Hello, sir.
Hello.
Sir, please, I'm not getting it.
You're not getting which side?
From the A and B, the 1,000.
But that was just a scenario. A and B need the 1,000. Just to tell you that if you are grant capital allowance, it is a good thing. Because if you are grant capital allowance, it means that you have to reduce your cost by what? An amount. And if you reduce it by an amount, it means that you'll be paying a lower liability, lower tax. Right? A lower tax. So if someone is granted capital allowance, someone is not granted capital allowance, the one that is granted will be paying a lower amount because they've allowed you to deduct an expense that you made, right? They said you deduct it so that what is left, you will compute the tax on it. But someone that wasn't granted capital allowance will be paying 30% on the 1,000. So that's why they said, so 30% on 70 will be how much? 750 will be how much? Is it 225? And then this person will be paying how much? 1,000. This person will be paying what? 300. So this person is having a higher liability, right? So here, this is the cost. Now this has become the cost, right? This is the cost for year 4. We are thinking that this is the cost for year 4, right? Because it was here as a written down value, but it came here as the cost. Now, they said in the same year 4, there has been what? There has been what? A scrap value. See, bro, from expected machine terminal value, I said that the terminal value is the last year. The last year. That's the terminal value or machine scrap value, or machine scrap value at the end of the 4 years. Assuming they didn't even say machine scrap value, terminal value, it means that is the scrap value at the end of the 4 years when production was 2 million. So we will have to deduct it. So let me tell you. Listen. Total capital allowance. Total capital allowance. If you don't know the formula, total capital allowance is equal to total capital allowance. So total capital allowance is equal to what? Is equal to your cost minus, or let me say initial investment. Cost minus your scrap value. Are we fine? Can we proceed?
Yeah. So a question. Okay.
Okay.
Oh, so meaning that when a scrap value is given to you at the end of year four, you don't calculate with a capital allowance percentage, but rather the difference between the scrap value and the cost of the assets at the last year, right?
Yeah, so assuming we didn't see any what's the name? Scrap value, sorry. Would have just continued with this, right?
Okay.
Would have just continued with this. So, okay, if you want it that way, we can also get this same amount. We can also get it by doing this. What is the capital allowance that we had here? What is that? Is 87650, right?
Yes.
87460. Yes. Then the one that's saying that why didn't we use this one? You can use this one too. So that is 2040850 minus the scrap value 2 million. I don't know, maybe your TA use a different formula. So let me use this one too. So what are you getting for this?
I'm getting 40,850.
40,850. Add this 40,850 to this amount, to the capital allowance that you computed on this. Add it to it.
Yes, you'll be having the same amount.
Yes.
Yes. So you can either do it that way, or you just deduct it from the cost. Just deduct it from the what cost, which is this amount. Or you can take this amount, deduct it, deduct the scrap value from it. Whatever figure you get, you write it, plus the capital allowance on this. Then you add it to, you get the same amount. You can see that my formula is, the first one is more easier, right?
Yeah.
Faster.
Yeah, and
So
by the second one is more understandable. I mean,
the second one is more understandable.
Yeah.
I will work here. All right. So which one did your TA use?
The first one.
He used the first one. Okay. So you see, so you add this to the capital allowance that you computed, this one. Either ways, you should be getting the same answer. So you can choose the one that you want. So now what will be the capital? So you have to, let's quickly insert them into the...
But one more thing.
Okay.
Okay, so in the case where the scrap value is higher than the amount at the year 4, you say you are going to have balance charges. How did you treat that?
Is it balance what?
Is it
balance
right?
charge?
Yes.
Okay. And this one will be what? Balance allowable. Right.
Yeah.
So assuming you're having 2,000 and then you're having what? 3,000. So what will be the difference?
1,000.
And that would be a balance what? Charge. So if it's a balance charge, then you compute the percentage on it. What is the percentage on it? The percentage, tax percentage. Because we have not paid tax on this. So it's 30%. Because I don't know, we will know in your book that is 2,000. What could 𝑗𝑠𝑘 3,000? You are having an inflow of 1,000. We want to compute tax on the 1,000. You want to cheat us. Wait, shut up. We make it profit. So you pay the tax. So